Welcome, my name's Djerriwarrh, General Manager of Business Development and Investor Relations for Djerriwarrh Investments. I have with me this morning Mark Freeman, who's the CEO, and McNeill, who's a Portfolio Manager for Djerriwarrh Investments. So Mark, we've just announced our half-year results for the financial year. Perhaps you could just take us through what the key financial parts of those results were.
Thanks, Jeff. I'll just pick out the highlights and then we can pass over to Brett to talk more broadly about the portfolio markets.
Yep.
The net operating result for the half was $21 million, 4.3% down from the $21.9 million in the previous corresponding period. The key components of this result were revenue was $18.8 million, down slightly from the $19.5 million in the corresponding period last year, while income from option activity was strong at $7.5 million, but it was down from $9.4 million in the corresponding period last year. The interim dividend was maintained at 7.25 cents per share, fully franked. Based on the interim dividend declared and the final dividend paid, the dividend yield on the current net asset backing is 6.4% grossed up for franking credits. Based on the net asset backing and including franking, this represents an enhanced yield of 1.9% higher than the available, or what is available from the S&P ASX 200. The management expense ratio remains low for this type of product at 0.46% with no additional costs.
All right, Brett, Mark's touched on the financial results. Perhaps you could talk us through sort of the two key objectives we have, which is enhanced yield and also total return over that longer term. Perhaps you could just talk about what's driven the performance there.
Yeah, sure. So the primary objective of Djerriwarrh is to deliver that enhanced yield. And as Mark talked about, the profit result for the period enabled us to pay a good interim dividend of 7.25 cents, which is more than covered by the net operating profit. So a sustainable dividend we think is really important. And that's produced a really healthy enhanced yield above the broader share market. In terms of the second objective, which is to deliver good growth over the long term, both capital and income. So if we look at the capital side, the NTA performance was below the market for the 6-month period, which is a function of us writing extra call options to generate that income, but being capped out on the capital growth in a strongly rising share market. And so that's had implications for the total return of the portfolio being a bit below the market, but also about some of the adjustments that we've made to the portfolio.
So touching on the adjustments, I guess some of those adjustments have come about, as you said, because of the exercise of call options. What were the sort of key changes within the portfolio over that 6 to 12 month period? And I guess also, how did you position the portfolio through this, what has been a very strongly rising market?
Thanks, Jeff. So whilst the approach and the strategy is unchanged, the portfolio looks quite different now than it did 6 months ago. We've probably had more change than we've had in the last 6 months and in most other periods, and it's all been the result of the exercise of call options that we've written. So that's basically been the vast majority of the selling that's taken place, and it's almost all been in the banks. So to take a step back, go back 18 months ago, Djerriwarrh was a big buyer of the banks when they were out of favour, and we thought the valuations were very attractive, like high dividend yields. Since then, the banks have been one of the best performing sectors on the ASX, so the share prices have rallied a huge amount, and the call options that we've written against the banks have largely been exercised, particularly Commonwealth Bank, Westpac and National Australia Bank. So the end result is that Djerriwarrh owns a lot less of the banks today than we did 6, 12, 18 months ago. And we think that's the right position today given where bank valuations are. So on the other side, what have we reinvested the money into? Well, where we see value in really high quality, typically large cap, blue chip stocks with very healthy, fully franked dividend yields. And from that end, some stocks that have been out of favour, such as the supermarkets, Coles and Woolworths, also into Telstra, and some of the major leading resource stocks like BHP, Rio Tinto and Woodside. So the result of that is that our dividend income for the next while will be much more skewed towards the companies I just mentioned that we've been big buyers of, and a lot less reliant on the banks. And so those changes and how the dividend income will be reshaped is really a function of the option exercises, but also we've deliberately positioned the portfolio quite conservative at the moment. And I think that's one of the key messages from this result is that we see market valuations as pretty high. We're being patient in terms of how much we want to reinvest. And because of that, we're running a net cash position. And we've started the period with call option coverage at 41%, which is just above the normal range that we have of 30 to 40%. So we think a portfolio that's quite conservatively positioned today, which to us is right for this type of market.
Okay, thanks, Brett. So Brett sort of touched on a fair bit on the outlook there, Mark. Have you got any sort of further comments to make about what you're seeing over the next 6 to 12 months or where we are now?
Yeah, look, I think we're more broadly cautious on markets, really around valuations. I think generally businesses are in fairly good shape. We like the companies we've got, so it's not a comment against those. It's really the market we think has got ahead of itself in some areas. Brett's touched on the banks. We're seeing PEs like we've never seen before, certainly not in my time, and historically low dividend yields with not much profit growth. But we think broadly the banks are well run, but it's the market that's taken control of the share price and pushed them up to these levels. So we're cautious on that sector, and we're seeing I'd call more extreme valuations across other sectors as well. So that makes us cautious, and therefore we should be careful about when we put money into the market, what we're buying and the price we're buying it. And that's our general approach. And there's a lot happening in the world, but at the end of the day, it tends to be valuations that push things around ultimately. So yeah, so we've got that more cautious stance.
Okay. All right, thanks, Mark, and thanks, Brett, for your times.
Thank you.
Thank you.